Well, hey, thanks for joining our session today. I appreciate your patience as we got set. Hey, so today we're going to be sharing some thoughts around the topic of roadmap to value. We're going to jump around a little bit just to cover a couple topics quickly. We can't resist to give some sort of market update from what we're seeing, and then we'll jump into some steps around how you can prepare, how a buyer's going to, key areas a buyer's going to look at as they're assessing an opportunity, and then some really practical steps that you can take as a business owner as you're looking to prepare for sale.
I apologize, I'm the one that's running late, so I'm the one holding you up, spilling my coffee and all of that. But we'll give this presentation because we're oftentimes asked about what drives value. And we tend to look at this presentation in two facets. One is transactional values, which is what everyone wants to talk about. And then the other thing is what creates value. And we do this presentation a lot with CEO roundtables. We do it with private equity groups and talk to them about their portfolio companies and how they can drive value in them and so forth. But what they usually get out of it are great ideas. But our ideas are just one thing. It's really the execution of that idea that drives the value. So when you take away any glimpse of idea to drive value, think about how you're going to execute it as well.
All right, so if we start with just some brief thoughts on what we're seeing in the environment, we've got some charts because we love data, and we've touched on this a bit in the broader session here, so we won't be too long-winded here. But if you ask 5 different professionals in the industry what are they seeing, where's the market going, I think you're going to get 5 different answers. But what I can tell you is, if you look at the last few years, 2021 was very, very strong. 22 was down, but relative to any of the other prior 10 years in that chart, we still saw a very strong market, and we experienced that ourselves. We as a firm were one data point, so we're a sample of good Midwest businesses, but we continue to see really good activity. So upper left, you've got activity levels. Bottom left, you've got some valuation multiples. Again, this is a very broad set of data, so we'll kind of drill down a little bit in a subsequent slide, but you did see valuations come in a little bit. So what we're seeing more so though is if you segment this between much larger deals and then lower middle market, a lot of that decline has been driven by the larger segment. So in our segment of the M&A market, we're seeing relative stability. We're still seeing deals getting done at good values.
Yeah, and just to add to that, Nick alluded to it, but it truly is 2 different worlds. So if you're less than, say, a $50 million deal, we're really not seeing much change at all. We're talking about financing, the cost of it, we're talking about the leverage of it, and that maybe impacts the thought. Maybe there's some hesitation from buyers saying, well, is the market going to continue as it is? Are customers going to drop? Are we going to hit a recession? But we're really not seeing that, or at least buyers can get over it. When you hit a $50 million plus deal, then we're seeing a lot more concern. And it's really driven by the leverage ability. We'll talk about a little bit of that today. It's not necessarily the cost of financing, it's the amount of financing. And that's really what is driving an impact on those $50 million plus transactions that we'll talk about. I'm not sure if you mentioned this as well, but feel free to throw out any questions. Yeah. So you don't want to hear us just talk for 30 minutes straight, so feel free, and you can fill right away. Here we go.
Is there a minimum EBITDA on that chart with these multiples? I mean, is that a minimum of 5 million of EBITDA, 10 million of EBITDA, or what?
Yeah, I don't have that exact answer. It's all cap is our understanding, but yeah, we could get you an answer if you're interested.
Yeah, we'll get an answer, just so you know. So you'll see on the next page, I believe, that we'll break it down by like 25 and below, or 10 to 25, and 25 to 50, 50 to 100, and so forth. This is all transactions.
Thank you.
Yeah, but it really quickly, a lot of the factors that underpinned a very strong environment, there's some additional uncertainty for sure, particularly around the leverage availability, as Corey just mentioned, but the availability of capital, so private equity, dry powder is very often referenced. stat. The supply of available companies for sale, particularly quality companies, there's a lot of companies that need to change hands, but not all of them are very high quality. So, I'm of the belief that in any market, a very high quality company there's going to be a market for you. So, around growth initiatives, in a world where you have, modest growth, it's very often that you find corporations that are looking to augment, one, you can hit strategic initiatives, but also to supplement growth. And, so we're seeing interest even, in today's environment, maybe corporates perhaps have the upper hand in terms of coming away in a competitive process. So about the leverage environment, I think we can be real brief here. The punchline, debt plays a very important role in any acquisition, whether it's going to a corporate or it's going to a financial sponsor. Debt has gotten more expensive, and the availability of leverage has tightened some, but we're still finding that, real-time data points are as good as any, where they're able to secure the financing they need. Maybe they need to look a bit broader in order to do so. So previously, you had a number of options. Today, maybe you've got fewer options at the value you want to support, but you still are able to, secure the financing you're looking for.
It is getting more creative. This is where seller financing comes into play. So if you're really struggling as a buyer to get financing, you want to bridge that gap between equity and debt a little bit. Seller financing, maybe at a lower rate or fixed rate, can come in handy to support, the kind of post-acquisition challenges. So that's an important thing. But when you look at the changes in these rates, it's really significant in a very short period of time. So it is, when you think about it just over a high level, yeah, interest rates went up, but they went up really, really quick, and that impacts things.
And last, to your question, so what you'll see, on the bottom left is probably most interesting here. You've got the quarterly splits for the EV to EBITDA multiple across 4 different segments. It's by enterprise value. And so at the very, the first one shown there, 10 to 25 million of EV, and then the very bottom one is 100 to 250. If you follow this line across, it's really clear that there's been pretty resilient multiple movement. It's pretty consistent where it's been. Third quarter was a bit of an anomaly across the entire data series. Can't necessarily explain that, but if you look across, the 10 to 25, the 25 to 50, not a lot of movement over the last 8 quarters. It's when you get to the 100 to 250 where you've seen probably a turn and a half come out. So size does matter a lot, and you're putting generally speaking, you're putting more leverage on a deal that's larger versus smaller. So that's a piece of this. And then, to the extent you're interested in following this information on a ongoing basis, we do publish a number of these data points in our M&A quarterly newsletter, which is available for free to anybody.
We're often asked, how to drive value, and that's what we're going to talk about today. But one of the things when Nick describes the larger the transaction, the higher the multiple, and we talk in multiples because it's easy to talk in multiples. Ultimately, when you talk about buyer valuation, acquisition valuation, you're generally looking at a discounted cash flow model or an LBO model that's going to drive the actual value of the business. So we can talk about that at any time. But what we look at when we see the multiples go up as the business gets larger is essentially that comes into play multiple arbitrage. So if you're looking at acquisitions or really driving the value of your business, you can take your business, you can grow by buying smaller businesses as you put those together, then you not only get the increased cumulative synergistic EBITDA, but then you also get that multiple arbitrage of a higher multiple. So there's 2 ways that you're driving value there. So just a tidbit. All right, kind of going into the next section here, we'll talk about what is the value of your business. This is the magic question that no one knows, and we're asked this all the time, and people want an answer within like 30 seconds, what is my business worth? And we can never give them an answer, and we're not trying to be vague, but it just depends on a lot of stuff. You know, what is important to you? What is your business? What are the characteristics of it, and what you're looking to do with it? So, you know, a company is really worth ultimately what someone wants to pay for it. And who that person is or who that company is and how they're paying for it can differ so significantly that it's really difficult to understand. So the interesting thing is, as you go up these different exit strategies, whether it's liquidation, gift, ESOP, management buyout, and ultimately to probably the most theoretically valuable buyer as a strategic buyer or a PEG add-on. A PEG add-on, if you don't know what that is, private equity group, is if you look at a private equity group and they are buying this company as a platform, that means they have no other opportunities or portfolio companies in that space. They're going to buy it with no synergies. They're just buying it for what that business is. But if now they say they have a platform of a $20 million EBITDA business and exactly what you do, and they're going to acquire your $10 million EBITDA business into that $20 million platform, all of a sudden they're a strategic buyer. So it's almost the best of both worlds. You get a professional investor that has a reputation to make and is efficient at getting deals done, mixed with some potential synergies and strategy to it. So that's why they're generally thought of as the one that can pay the highest amount. As we look at this though, when we market a business, the point I want to make is we always go to a broad population when that's the scope of the project. And that could be 300, 400 potential buyers in a confidential manner. And we call it the rule of two. The largest offer that we get is generally going to be twice the value of the lowest offer. So you think about that. This is going through the same process. Buyers looking at the exact same materials. One comes in at $100 million and one comes in at $50 million. That's a dramatic range of value that happens on, I would say, every transaction.
Yeah, just about every single one.
So now when someone asks me, what's the value of my business? Is it 50 or is it 100? It depends who you're talking to, what the process is, and so forth. Buyers will definitely look at your business differently. So one buyer, I talked about the private equity add-on. If you have a 50% customer concentration, maybe they can absorb that acquisition without too much concern because it's like they're acquiring a good customer for a portfolio that they already have. Now, if you have 50% customer concentration and they don't have any entity in which to add it, that's a big customer concentration. So they look at it as a lot more risk. Next, we'll look at the value factors and control. And what's interesting here is there's a number of items that drive business and factors that really can be taken into account. The market conditions, you can't always control those. It is what it is. You can time it a little bit, but none of us really know exactly what's going on. Financial profile, you can drive that as well. Understand your margins, increase your margins, understand your EBITDA. Business traits, again, going to the customer concentration, the end markets. Vince was saying that food companies are still hot when he was on the panel, and we agree with that. We're still seeing a lot of interest in food. We're seeing a lot of interest in aerospace, technology, and so forth. So what are your business traits that someone is potentially going to look forward to? And then the buyer options and structure. This is where it can really, really vary. So if you're selling a company, are you selling it and getting an earn-out or cash, or a seller note from a structure perspective? Are you a C Corp and selling assets versus stock? That's going to be a significant impact to what your valuation is. But the overall here is there's a lot of variables that can drive the value of your business, and focus on those that you're in control. Okay? The management team was said on the panel multiple times. You can control how solid your management team is. Sometimes it's an investment to really upside them. Next slide. Any questions yet? Hearing none. And then the other item when we look at the valuation of a business, going back to the question of what is my business worth, are you a quality business or are you an average business? Obviously everyone, just like if you have kids, you think your kid is the best thing in the world. So everyone thinks they have a quality business, but that's not true. There are quality businesses in this aspect, since data is very difficult to get on private transactions. So we go through a source called GF Data, And this is one of their charts that they always report. It's based on certain aspects of the underlying business. And I don't have to read it for you here, but it's based on certain EBITDA margins and growth. So we have valuable businesses or quality businesses that in 2022 got a 7.9 multiple compared to a 6.3 multiple for those that didn't meet those criteria. 124% premium. That's a significant difference, right? So when the person at the country club is telling you I got a whatever multiple, does that apply to you or not? And it really depends on the underlying business. Next, we'll cover some value driver, wrong one. Last thing, current market dynamics. To just finish out this section before we get into really the nitty gritty and what everyone should be looking at to drive value of the business from an operating perspective. A lot of times I say this whole front section, and I'll leave it to the investment banker and go through some conversation with them. The next section is where you can really kind of dig in from an operational perspective. But people do want to know what's going on with the current market dynamics. So what's hot and not? Since COVID, home service businesses. 5 years ago, we really were not seeing much transaction interest in home service businesses, HVAC businesses, roofing businesses, and so forth. Since COVID, we've really seen almost a re-interest in these types of opportunities. And a lot of the companies, too, have changed their operating model to focus more on recurring revenue. So they might put service agreements in place. You hear that a lot. They probably tried to sell you on a home service agreement for your HVAC company. And they're very meaningful when it comes down to the underlying value and the overall interest. Private equity groups are now highly interested in HVAC companies, which 6 years ago they didn't care about at all. So it's really an interesting dynamic there. Packaging, medical, aerospace continues to be strong. Those have been strong for a long period of time already. Project-based capital project companies, those are challenging right now because of this skepticism of when a recession hits. So if you're in the business of where you sell a few $1 million projects a year, whether it's capital equipment manufacturing, whether it's large construction projects, those are becoming out of favor a little bit right now. It changes, it ebbs and flows, and every underlying business is a little bit unique, but that's what we're seeing right now. And lastly, construction companies continue to be valued a little bit lower. They've always been valued a little bit lower for a number of reasons, but certainly in the current market that we're in, that really becomes evident that if people get consensus that the inflationary market, the interest rate market are all changing the potential for construction 12, 18 months down the road. No one wants to go in and buy a construction company, or what I'm really talking to about is a construction branded or construction products company. What's in highest demand, if anything, with certainty? So if you can market a business, and we go through this all the time, what is the underlying business and how do we present it as either having recurring revenue or what we would refer to as reoccurring revenue, possibly it happens every 2 years or something like that. That's what's going to drive interest in a business. Any kind of repeatable service, products, all those subscription sources that we don't even know we pay on a monthly basis that we're all stuck paying, those are highly valuable right now. And then management teams in place. Again, this comes down to there's less uncertainty if a buyer buying a company knows that the people running it are going to be the same people before and after a transaction. So very important there. Rollover equity is becoming more and more important, and we can do a presentation on rollover equity alone, but that's becoming more and more important because of some of the dynamics of skepticism of future projections, because of financing. All of that is making it more expensive, so a buyer wants to make sure that the seller has skin in the game. And if it's not rollover equity that you're willing to do, then you're probably going to be looking at more earnout or seller note around it. Just a few other things on this slide before we move on. When you sell a business, it's really important to have projections and to make sure that those projections are realistic. Anyone can put a hockey stick projection out there. We see them all the time, but a buyer is really going to drive through those, and you're going to be reporting financials on a monthly basis as you go through the process. So if all of a sudden you start missing those projections, then you have a much bigger problem than if you just went out there with appropriate projections. You can still be aggressive, but you want to make sure you can hit them or have a really good story as to why you didn't. And then just a few aspects of what we're seeing in the market right now as to some of those unique questions. And one is around any business that has grown. Is it price growth or is it volume growth? And that's a really big question because you have a lot of buyers that they don't really want to pay for price growth because prices might come down again. So they're really skeptical there. So we make sure you have the analysis and the data to perform that kind of analysis. COVID impacts in 2020, we really don't see that as anything more than an anomaly at this point, as far as if you had a down year in 2020, so don't be as concerned about that. The challenging thing is we almost see the reverse of it now, where 21, 22, and now into 23, buyers are skeptical that you potentially got a COVID boost, and now they might be negatively impacting your EBITDA when they adjust it. So some things to keep in mind. And then the lending market we already talked about.
All right, so the next section, preparation and increasing value. So we want to touch on, as a business owner, when you are under the microscope, what are 5, of the key areas that a buyer is going to be looking at and focused on, and they're going to diligence these sections, very deep, and they're going to get a good understanding of it. So it's important to be prepared to have thought through a number of these questions ahead of time, and Corey will go into further detail around some of the kind of the preparation or planning steps. And just as a general comment, to the extent anybody wants a copy of the presentation, you're welcome to ask us, and we can share it via email, no problem. So performance, and I like to segment this into quantitative versus qualitative. The quantitative piece of this, it's what does the P&L tell me? What's the balance sheet tell me? What does the cash flow tell me? Are sales going up? Are they going down? What are margins doing? How did you perform through the last recession? These are things that any buyer can look at it. Sometimes it's binary. If the business cycled in 2020, I'm not going to touch it. That's just the way it is. But the more important part of that, I guess, probably equally important part, is that there's a story and there's an understanding of why things happened the way they did. So being able to really speak to the P&L and what drove that performance. So to have a track record that's credible, you can speak to this is why it happened. We implemented this initiative and it resulted in this. That goes a long way. And particularly when you come into instances where you may have a business and maybe your business performance chart looks something like this. You've got a phenomenal track record for a number of years, and then you just hit it, you have a hiccup. It could be totally explainable. And if you can, come across in a credible fashion and really help us bridge that gap, it wasn't that, there was pent-up demand and we just exploded the following year. If there was a real story there, that will go a long way to helping a buyer get comfortable with your performance.
This is always a dynamic that's really interesting to me because business owners think they know their business and everything that's moving through the business. And we know data, and we try to apply what the business is doing to that data. So oftentimes we'll do some analysis and we'll ask certain questions of the business. Why did revenue go down here? Why did margins go up here? Whatever the question is, and they'll tell us the answers. And then we'll dig into the data and we'll say, no, that's not what's happening here. This is what's happening here. So a lot of times they don't actually know what's going on with their business based on the data. What we don't want is them to get into a management presentation in front of a buyer and tell that story that the buyer is then going to poke a hole in. So it's really important to relate the data to what's actually happening and tell the story concisely.
Just a final point on this, to understand how your performance compares to your peer group too. It's one thing to grow 10%, but what if the industry's growing 30%? You're losing share, or the inverse of that. Just to have a general understanding of that and being able to speak to why. Second item is people. At the end of the day, businesses are just an organization of people, and the buyer is going to really need to get comfortable with the team that's there. You heard that earlier in the broader session, how important the management team is. Taking that a step further though, the broader employee base, what are the trends? What's the tenure of the employee base? Is there turnover? Who's leaving? Why are they leaving? Are they leaving with important information? Is there tribal knowledge in this business, or have you documented everything and it's, it's more systematized at this point? Those are the types of things that they're going to be looking at and wanting to get an understanding and get comfort out of.
I think people lose the thought on this of how important it is. And we heard it on the panel today in the big group. But do companies buy businesses because of people? And you look at Truman out there, I mean, you want to be involved with them, right? It's a lot of energy, there's a lot of passion, and we see that over and over. Certain buyers find an interest in an opportunity that we're representing interesting, and it's really solidified because of a person or people on the management team. They want to work together, so it's incredibly important.
Yeah, and a very common, piece to this analysis is just sitting down and looking at your org chart and just studying it. Is this appropriate for our organization, or do we need to add a couple people to round this out? That's just something to be expected. The next thing we would point to is your position. So, a buyer's going to want to understand what the general landscape looks like, and then how do you fit into that landscape? What's your differentiator? Are you the low-cost provider? Are you the exclusive provider to something? But to have an honest understanding of how you fit into the ecosystem and why customers buy from you, those are critical to really understand and then articulate to the buyer to get value for that. Oftentimes, it's this type of analysis that best helps us position the opportunity in the marketing materials and on buyer calls with prospective buyers. But just to be able to tell them why you're special, why you're going to exist, why your position is defensible, it goes a long way, and it's really necessary.
And this is one too where you have to be honest with yourself as a business owner of what your position is in the market, because a lot of our clients think they have a different position than they actually do. And a buyer nowadays is going to do a market study or a customer study to really understand how the customers see you and how the competitors potentially even see your business. So that's becoming, really in, I'd say, 75% of our deals, we're seeing that, especially where there's a broader market that we're serving. So it is going to be something that's uncovered. So you have to be very honest with your investment banker to understand, yeah, this is our competitor here. They do a better job in this area than we do. But we're growing, it's an opportunity, and we're going to get there. So it's something to look into.
Question.
Yeah.
So in the previous presentation, they were talking about the sale disclosure and keeping that to a relatively limited group because of the stress. But when they start doing the marketing studies on customers, and those customers, I'm assuming I don't know how they approach the customers relative to the interest in the business, but there could be some sensitivity on the customer side too. What's going on? So help me understand that.
Yeah, well, there's never one direction to go, and there's always unique situations that you deal with. But I would say generally when I talk about like a market study or customer survey, that's done blindly, or it's done under the guise of customer satisfaction survey. So you hire a third party, buyer hires a third party, they go out to a select group of customers and they get feedback from those customers under the presentation that this is to better our partnership with you as a customer, we want to better our services and understand what you really think of us. So that's probably the most common way. The other way we will see is with certain select customers, there is just an honest conversation of this is what we're going, what is happening. We're going to be potentially transacting this business and you're important to us. We want you to bring you in before the close. And those are usually the case when there's maybe a consent that's required. Okay, so a legal consent that's required for a contract. But those are the two ways that it's usually done, is completely blind or just a very upfront approach.
There was another, on your previous slide too, there was a comment relative to the non-competes. And as I understand, some of the federal laws may be changing on this work. Can you comment just briefly on that?
Yeah, well, I'm not an attorney, and it's definitely changing, and it's still being worked on. John might be able to give a little bit more guidance here. But it is changing drastically to potentially reduce the ability to kind of uphold a non-compete agreement. Now, there's a difference between an employment non-compete agreement and a business transaction non-compete agreement where you're paid a significant amount of money to potentially uphold and give strength to the agreement. So that's what I'll say there without being an attorney. So I'll leave that up to the winners for true. Any question? One other mention that, so certain times when I mentioned the customer study, then usually they will state that we were hired by this company and we're doing this on behalf of them. There is a third that we're seeing a little bit more of now, and that is where they are just calling as industry specialists to do reports on the industry and not giving any client names, essentially. Okay, so that's kind of the third route that we're seeing a little more.
I find though that getting this information is a lot more difficult than it was 10 years ago, because I know with some of my customers, they won't give you any information.
Yeah.
And it's seen as part of their strategic understanding of what's going on, and they're not going to just blindly get this information.
Yeah, without complete transparency, you're always going to get a mix, right? You're going to get those people that actually really think of, hey, we have a partnership with this supplier to us, and I do want to help them get better and better, so I want to let them know what they could improve on or what they do really well. So you get those that give really good, honest feedback. You get the others that don't want to take the time to do it. So it's always going to be a mix. I'd say 5-10 years ago, when you did the just transparent, we're going to call your top 10 customers before close, that doesn't happen as much anymore, or really at all. But that would obviously be, you don't get a lot of feedback, but you're more making a statement as to what's happening. So to get the useful information from a buyer's perspective, it's usually going to be market study or customer study.
All right, we'll pick up the pace a little bit here as I keep an eye on the clock. So number 4 in this section would be around potential, really growth potential of the business. When buyers are looking at an opportunity and they're valuing an opportunity, they are very likely assuming some level of forward growth. And so it's going to be important that you have a roadmap. What are you shooting for? And then it's not just, hey, we can grow 20%, we're going to add a salesperson here or there. It's really breaking it down to nuts and bolts. And this is our strategy. This is the timing of when we're going to do X or Y, and this is the cost that it's going to take. This is the payback to really think through that. But also, if you have the benefit of time, to build out that forecast and then measure your success against that, just adds to your track record when you do go to market. Look, this is in motion. We're hitting our numbers. Do you want to be part of this? Do you have anything to add on that topic?
Yeah, I would just say that a lot of people kind of stumble on this point. Potential is everything. Potential is what drives the value of a business. And sometimes the buyer brings more potential than the seller has. But when you think about how you can drive the value of your business before a sale, you don't necessarily, say you're going to create a new product or new capability, it's going to take you 5 years to get fully integrated to where you get the revenue maximized on that side. You don't need to wait 5 years before you get some value for it. You need to make the investment. You need to get it going. You need to show some track records and some progress. And you can get, as long as you can make sure that there's a path there that you've already put in place, you can get some value for it. So from a timing perspective, you can move forward before it's fully baked into the organization.
And to round off this section is problems. Inevitably, things pop up. No business is perfect. It's literally impossible. What's important here is that you're upfront about what the issues are, and to the extent, again, that you have the benefit of time, if you can address these issues before going to market, it'll make life easier, and you will, increase value given the alternative of dealing with that while you're in market. These problems can be things as small as, you've got customer concentration issue, not to say that that's a small issue, but it's nothing in compared to some serious litigation that could be popping up. So to address these, whether it be on either end of that spectrum, proactively is going to definitely drive value. And we can touch on that further here.
And this is obviously a lot to cover in 30 minutes. So we're going to keep moving through a few things and just kind of fly through these sections. Obviously, we can talk more about it if you want to around the bar or where the serving area is out there. But page 19 here, I just want to go through a few items. So building value financial matters, 1 to 5 years before sale. How you actually build that value, and just to highlight a few things. Develop the reoccurring revenue streams. I mentioned this with HVAC companies, really putting service agreements in place. If you have an opportunity in your business model to be able to do something like that, it's really going to drive the value of your business. Diversification as well. If you look at certain buyers of businesses, if you're a PE, you're looking at a business purely from a financial standpoint, they might be uncomfortable with any business with concentration of more than 30%. Now, there's always a story to concentration, right? If you're selling to that customer for 45 years, there's probably limited risk, but you still don't know. So you have to get really comfortable with who those customers are, with what that relationship is, and so forth. And then personal matters. We see this a lot on deals where you just have a lot of personal things going through the business. Whether it's your vehicles, whether it's your boats or jets or whatever, real estate even. If you take the time to really position your business so you can get it nice and clean and sell what you want, that's going to always help in going through the process. Legal matters. You guys, some of the attorneys here can probably fill in a lot more than here, but review the legal and operational or organizational structure. If you have a C Corp and you want to convert to an S Corp, there's a big that comes along with that. So you have to have a certain period of time before that conversion doesn't impact you from a tax perspective. So understand those aspects of the organization. Look at stock certificates, any kind of obligations that you have out there, any kind of employee agreements, phantom stock, any sort of SARs in place. Those things really need to be cleaned up before you go to a process because they can potentially delay things. Review the employment policies too. Nick alluded to this earlier. For certain employees, you might want to put non-disclosure agreements in place with them. You might want to put certain state-put bonus plans in place with them before the process. And you don't have to go broad on those things, but for certain employees, it might make a lot of sense to do. And then review long-term contracts, because any contracts that you have in an inflationary time, if there's price obligations, then that's going to become concerning. Your margins are going to really thin down. So you need to really be aware of what those long-term agreements are that you have in place that ultimately a buyer is most likely to keep in place as well and be under the direction of. So that's a little bit longer, 6 to 12 months. What we want to work on is clean up the major contractual relationships of the business. A few things that I just want to point out here is when you go to sell a business, it is also visual. So we don't think about it because we think of the intangibles, we think of the financials, but just simply clean up the facility, right? If you're walking through a facility and you've got, I always remember going through like injection molding operations, you've got the pellets just all over, they're falling, you're kind of slipping on the floor as you're walking through. Just clean up the facility, that really shows well. And I always say too, our clients generally don't take our advice on it, but reduce the working capital in the business. Sometimes a business has the capability to reduce the working capital, sometimes they don't. But if there is the opportunity to really shorten those receivables, extend those payables, then that is a valuable way to leverage the working capital of the business and really decrease that. The last question, last page in this section before we let you go, and then I'll let Nick finish up with probably the most important slide of the presentation, is just pay attention to your financials. Most business owners think of this as an expense. And they really think, oh, I've got a controller, I've got a bookkeeper, I don't have to worry about this. GAAP and the adherence to GAAP is becoming so important. 5 years ago, we didn't see reps according to GAAP. We saw reps according to historical practices. And now we're really changing that. There's still some variation of it, but it's trending more towards a GAAP representation, which is really important. So pay attention to that, make it an investment versus considering it an expense.
Yeah, and just to finish things off here, so this is just the value of an M&A process. As Corey mentioned previously, we often do see the top offer and the bottom offer being about 2x. And so this is, plucked from, well, this could be sample data, I'm not sure exactly.
This is real.
This is a real one, okay. From many years ago, I'm sure. So, this would have been an instance where there was a preemptive offer at the table, and by, running a competitive full auction process, we were able to create, a private market, and really, at the end of the day, a successful sale process to a broad market of buyers is going to give you options and negotiating leverage. So our goal is to get you the best possible value. You don't always end up selling to the top value because of fit. I think they mentioned that in the broader session as well. But by running a full process, you give yourself options, and you will walk away with a much more competitive value.
And options are really important because there's always certain points that are really important to a seller. And it might not be value. A lot of times it is, but we do come across clients, we have current clients right now, that it was more important to them to find the right partner to partner with because they're going to continue with the business. So there are things that are more important, and it could be who that buyer is. It could be keeping the business where it is. It could be keeping certain employees in certain roles, whatever that is. But options will always give you more choices and a little bit more negotiating leverage. All right, anything else?
That's it, yeah. Any final questions? Otherwise, we're happy to connect outside as well.
Phil?
Have you guys seen anything negative or positive from the war in Europe?
And not unless you have a business in the Ukraine or a business that does business with Russia or Ukraine or someone closely tied. We really haven't. I don't know if you
Yeah,
have that
most
either.
of our clients are, pretty insulated. A lot of domestic businesses and dealing with mostly domestic customers.
Yeah, we have a few that did have some exposure to Russia and sales ultimately that ended up in Russia, but it was minimal amounts, not really material to the overall operations of the business. Any other questions? Or
Are you seeing any increased values around companies that have good IP and patents on products that you see in the returns because of that?
Well, we do, but they're not valuable in name unless you feel that there's some great cash flow that you can generate from the IP or the patents or any kind of proprietary process. So, there has to be some provability as to the market exists out there and it hasn't been exploited yet, and the patent gives you the protection. But it does add value when there is that proof of concept out there. So, yeah, there's always going to be value to it. It's better to have it than not have it, but there has to be cash flow that you can prove is coming that way because of those patents and that defensiveness.
Have you ever run across or heard about situations where the business is sold to a customer and then a competitor to that customer files an antitrust suit against the customer saying, wait a second, you can't buy this supplier because we're dependent on the supplier as well, and it's too critical. I mean, at what point do you start getting concerned about buyers that potentially are customers and the whole antitrust aspect? It's a little bit specific, but...
Yeah, you kind of veer the line of legal there. So from an antitrust perspective, what we generally look into is Hart-Scott-Rodino, which used to be a $101 million threshold. They just increased it. Kevin, John, you might know what the threshold is now, right?
It's 112-ish.
Oh, 112-ish. So they increase it every once in a while.
Is that a revenue number or enterprise?
That's enterprise value.
Enterprise.
So that's really where we run into it as a filing with for Hart-Scott-Rodino. Outside of that,
So if you're over, let's say you're at 150 million, you're going to have different filing requirements and...
Yeah, you're going to have to do a Hart-Scott-Rodino or HSR filing, and that's going to have to be done. You're going to have to get approval prior to the transaction. So generally, I think that's taking around 30 days, maybe a little bit more now, but about there. But yeah, so that's from an antitrust. That's really what we run into. Now, there's always questions around it, but it's almost competitive questions if you're below a certain limit, because from a buyer's perspective, if that buyer buys you and you're selling to a competitor of theirs, buyer's potentially going to reduce the value of the business because that volume and profitability isn't going to stay with it, or they might look at it as a benefit to potentially taking out that competitor. I don't know. Yeah. Anything else? Any other questions? All right.
Thank you.
Appreciate your time.